Joining us right now is Wells Fargo Senior Global Strategist, Scott Wren. And Scott, it is good to see you this morning.
Hi, Maria. How you doing?
When you wake up and see a market that's up 200 points right out of the gate after a market that saw the Dow down 4.5% last week, you want to buy or you want to sell into it?
Well, for us, we want to buy. And really, you know, if you look at technically 2580 to 2630, that's a good support zone in there. So we've been watching that. Weren't exactly sure that we were going to trade down there again. But obviously, we were down to the top end of that support range. And so we've been encouraging our clients. We don't think this expansion's over. We don't think the bull market is over. And we certainly want them putting some cash to work. And like most retail investors, our clients tend to have a little bit of cash on the sidelines.
Scott, morning. Mitch Rochelle, you referenced the S&P 500. Is your suggestion to your clients basically to just buy that index?
Well, Mitch, you know, we tried, you know, we have a lot of clients, obviously, who like to own a lot of single stocks, but also we do a lot of asset allocation, obviously, and the index. And if you look at sectors we like within that index, industrials, consumer discretionary, financials, healthcare, that's the way we want them leaning. We don't want them hiding in things like utilities and things like that. So, you know, whether they do it through ETFs or whether they do it through buying individual stocks, that's up to them. But certainly S&P 500 is a good foundation to own here.
How important is the Fed this week? What do you think about Jay Powell speaking on Wednesday at the New York Economic Club? Dallas Federal Reserve President Robert Kaplan joined us last week, and he basically is saying, look, the Fed does not need to keep the foot on the accelerator at this point because we are going to see an economic slowdown. Listen to this.
At this stage, you're going to hear me be much more careful and avoid being rigid or predetermined regarding our future moves. I think we might have some further moves to go, but I'm going to be very, in the lingo, data dependent and avoid, again, being rigid or predetermined about the path of rates and the pace at which we're moving. And I think that's appropriate at this stage in the cycle.
And that, of course, the futures were down. That was back on November 16th, a week and a half ago when he joined us. What would surprise markets, Scott, in terms of this Wednesday speech from Jay Powell Wednesday at 12?
Maria, I think, you know, really there's two events that are going to determine what happens here over the next 5 weeks and how we finish this year. One is, of course, the Xi-Trump meeting that's happening at the G20 on Friday and Saturday. The other one, of course, is the FOMC on the 18th and 19th. And I think what is likely to happen this week with Jay Powell's speech is he is going to set the table for that. Is he going to continue, and is the Fed going to continue with kind of a hawkish kind of tone, not strongly hawkish, but hawkish, or are they going to back off of that a little bit? And so whatever happens at the FOMC, I think Jay Powell is going to set the table for that. And really, I think there's a reasonable probability that we hear good news out of the Xi-Trump meeting. It won't take much, but also that there's a reasonable chance that we hear the Fed maybe back off a little bit, maybe be a little less hawkish. And if we do see both of those things happen, or maybe even just one of them, I think the market's going to be higher than where we are right now at the end of the year.
Scott, it's Dagan McDowell, but what do you make about the widespread, broad-based rout that we've seen in a whole host of asset classes? The Wall Street Journal writes about it today. It is global stocks. It is global bonds. It is oil, copper, burlap is one commodity that the Wall Street Journal mentions. 90% of 70 asset classes tracked by Deutsche Bank have posted negative total returns in dollars so far through mid-November. That seems to suggest something else is afoot that can't be solved by a truce between the United States and China on trade.
I think, Dagan, I tell you, the two biggest risks this year, and we've been talking about this for a long time, is the Fed making a mistake and global growth slowing down. And believe it or not, in one of our models, burlap is an input into that. So, I mean, that's an economic indicator that's worth watching. But I think it has to do with a global slowdown. And clearly, when 35 or 40% of the revenues for the S&P 500 come from overseas, you know, you need some help from these overseas economies, and people are afraid afraid right now that whether it's China, whether it's the Eurozone, Japan, that things are slowing down outside of the U.S., and we need that help to get to our year-end, what was our year-end target, 2,800 to 2,900, and certainly a year from now where we want our clients looking, where I think you'll have probably a north of 10% return. We need some help from overseas.
You say that everything is you sound very optimistic, and yet there's a lot of folks saying that next year growth is going to slow down. There's no way we can sustain this. You disagree with that?
Well, Lee, I tell you, here's the situation is, clearly we're not going to have 20+% earnings growth next year. The market knows that. It's known that this entire year.
How about 29%?
Right. Well, yeah, 20, in the third quarter, 29%.
Yeah.
I mean, just unbelievable. That's not going to continue, but it doesn't have to continue. I think we're going to be somewhere around that 10% range, maybe a touch lower. And if you have modest inflation and earnings grow 10%, 8 to 10%, something like that, stocks can do well in that kind of an environment. So we don't need to grow north of 20% for stocks to do well. So I think that's going to be the case in 2019.
All right, we will leave it there. Great to see you, Scott. Thanks so much.
All right. Thanks, guys.
Scott Wren joining us from Wells Fargo this morning.